We are seeing, strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a way to go. No one is declaring victory. That would be premature, and we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not. Expectations for inflation this year, both headline and core, have come down, really significantly in 3 months. That's a big piece of this. At the same time, growth is turned out to be very strong in the third quarter, is slowing. We're moving carefully. One of the things we're moving carefully about is that decision over that assessment, really, over whether we've done enough, really. And you see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table.
Well, the much-needed cheer coming in from the Fed. You're watching the market right here in ET Now with me, Ayesha, Faridi, Nikunj, Dalmia in the studios. The Fed has held rates steady at 5.25% to 5.5% and exactly predicted, or rather talked about exactly what the dot plot was indicating, that there are going to be 3 rate cuts which are going to be coming next year. And clearly, the markets have liked that. More importantly, you've seen a big cool-off come in on the yield, and I think that's bigger cheer for equity markets all across, and I think we're sub 4% now.
So Ayesha, nobody saw this kind of a change in narrative coming from Fed. Everybody thought that, look, everybody knew that they will not cut rates last night. So that is on expected lines. But the fact that they've used the word there is good news on the inflation front and growth has peaked out. So what has Fed clearly indicated? Fed has indicated that inflation has peaked out, growth has peaked out, and the cost of capital in the world will start coming down. I think in this time, Ayesha, Fed is just trying to be ahead of the curve, because post-COVID, they were so behind the curve that they were not able to control inflation. This time, given that they have access to data, they can read whether US GDP is going to move, what kind of growth assessments they have for 2024. They are just preempting a soft landing for the economy. But for me, the narrative is that the interest rate hike cycle in the world, courtesy Fed communication last evening, I think is evident, has peaked out. That, I think, is the biggest headline for all of us.
Yeah, and that was the big surprise as well. And I guess that's why you're seeing that big jump up on equity markets. It's been an extremely strong handover. The US pre-market futures have jumped up, strong close coming in for the Dow, and pretty much across world markets. And Asia as well is picking up the same momentum. While Japan has ebbed out, you're seeing actually Hong Kong lead the rally. And that's pretty much what the GIFT Nifty as well suggests. Well, let's take that discussion point forward. We've got James Knightley with us, and we've also got Cameron Brand joining in on the show right now. Gentlemen, hi, good morning and good evening to both of you in your time zones. James, if I could start off the discussion with you, while they've exactly talked about a status quo, what the dot plot was indicating, that there are going to be 3 cuts perhaps next year, but the commentary on inflation, does that come in as a surprise?
Market was generally expecting the Federal Reserve to give a very...
James, there seems to be a bit of an audio issue. We'll just come back to you. But Cameron, what was your reading from the Fed commentary and the kind of excitement it's instilled across world markets?
I was a little bit surprised. I was expecting them to sort of play a very, very straight bat in cricketing terms going into the holiday. They've been very careful not to let market optimism run away with itself and set the stage for having to keep rates even higher for longer. The market reaction was in keeping with what we've seen this year. I mean, the Fed may have been in a tightening bias for a while, but the markets have certainly been in an optimism bias. And most of the major narratives until the Fed really kind of shut them down in the third quarter were this year being pretty optimistic that China would rebound, that the Fed would pivot. Markets are looking for reasons to move higher, and today's meeting seems to have given them that. Though I would caution that there seems to be a pattern too of an optimistic response followed by a slightly more cautious follow-up as people parse the fine print and take a slightly harder-headed look at what the Fed is trying to convey.
Cameron, a peak in US interest rates has always coincided with a weakness in dollar and more flows into emerging markets. Do you think the historical template will play out again?
I think there's a good chance, but what we've seen from a mutual fund perspective this year has been a very heavy focus on just a couple of major emerging Asian fund groups, of which dedicated India equity funds have been to the fore. But China, Taiwan, and Korea funds have also done well in terms of attracting fresh money. The rest of the emerging markets universe has really not done so well. And we're still seeing outflows more often than not from the diversified global emerging markets funds, which are sort of a bellwether for broader sentiment towards emerging markets.
Cameron, so when it comes to specifically a market like India, where there is visibility, there is reasonable amount of growth, valuations are not really stretched. This kind of in turn, do you think will augur well for 2024 allocations? Are we in for bumper allocations coming by global allocators for India starting 2024?
You're certainly heading in the right direction. We've seen allocations in the diversified fund groups go up. In terms of inflows to dedicated funds, we're still in a record-setting run of weekly inflows. So there's no doubt India's very much sort of in the eye of investors, especially those that feel they need to make some kind of allocation to emerging markets. A lot will depend, honestly, on what happens in China. If China decides that it wants to try again for a 5.5% growth target next year and actually deploys the stimulus needed, then I think some of the money will start returning to China. We'll have to see that if that happens. The Chinese authorities have been, they've stuck to their guns this year. Pursued policies aimed at not inflating bubbles and trying to make sure latent ones within the economy don't turn into really serious ones. So they've constantly disappointed on the stimulus front. And if they keep doing that, then I think India is looking at a steady increase in allocations and flows.
Okay, Cameron, just wanted to understand in detail what's the view on emerging markets. Well, of course, it's the Argentinian ETF, which has been the best performer year to date, surprisingly. But just wanted to understand where things lie when it comes to India, because while we've done really well year to date, but still got a lot of catch up to do, even with the US equity markets at an index level, or for that matter, markets like Greece, Argentina, Egypt, etc.
You used, I think, the right words, catch up. There's considerable potential for catch up, really outside, as I said, a couple of the major emerging Asian country fund groups. What's happening in Argentina doesn't surprise me at all. The one reliable indicator that I've always seen over the years in terms of an acceleration of fund flows is a credible reform story, and Milei's chainsaw is roaring. For how long, who knows? But So I certainly think that Argentina's potential reform story will sort of help focus investors on Latin America. And in fact, we've been seeing that. Emerging Europe and Africa are sort of suffering death by 1,000 cuts, ranging from geopolitics to the dependence of emerging Europe on what happens with the Eurozone and EU. So I think that the view is very Asia biased. It's still very cautious in broad terms, and it is fragmented. As I said, the EMEA universe, it really is out in the cold at the moment. Latin America is beginning to see some signs of enthusiasm, and as I said, the big beasts in emerging Asia have been doing well all year.
Cameron, great to have you on the show today. Thanks for taking the time out and joining in. Well, in case you're wondering why you're seeing the kind of green that you're seeing on your screens, not as much for Asia. There, of course, markets like Japan are taking a bit of a backseat. But look at the US equity market overnight. That's been just fabulous. You've got the yields, which have now cooled off sub that 4% mark. A 500-point move coming in for the Dow. 1.5% higher for the S&P 500 and the Nasdaq as well, which sprung up by about 200 points. So extremely strong handover, and I think if Nifty is pretty much feeling that same kind of enthusiasm. So seems like maybe another dash at that all-time peak once again for us too. But Naresh, what's on the card? Seems like we were waiting for this global trigger, and now we should have that fillip coming in after much consolidation past few days.
Absolutely. So then after such a move, it gives a good reason for a spike in at least the heavyweights and names which were trying to break out. So a lot of banking names could take leadership today. And we test that 21,200, 300 mark, which has been a target for this current move for the short term. And we did take a good pause for a few sessions, so that makes it more positive. Same way on the Nifty, on the Bank Nifty, expecting further a dash towards 48,000 in the near term. So overall, the bias remains positive, continue to hold on and keep looking at fresh breakouts in the banking space.
Okay, fresh breakouts of the banking space. Kunal, hi morning. You think the banks are going to lead the charge today?
Yeah, I think it should be banks which could lead the charge, but it should also be many of the other sectors, as well as the underperforming spaces, like for example chemicals made a good comeback in the last couple of trading sessions. I believe that that's a trend which should be in the making. You've seen many of the tier 2 NBFC names. These stocks are also trying to make a comeback for themselves. So there's evident breakout into these stocks. And I, over the last couple of days, we had an approach of buy on dips. So we had the 200 odd point dip or a correction for the Nifty. Try to take advantage of that, and now we could be looking at a breakout above the 21,000 mark. So we could be now upping the base for the indices from 20,000, 20,500 to possibly 20,700, which could be a fresh support for the Nifty.
Okay, on that note, let's talk stocks as well. Naresh, what's on your list?
So first is the buy on State Bank of India, SBI. The stock has come very close to the previous all-time highs of 630. As well as for the last 1 year or more, it has had multiple resistance at around that 620 to 630 mark. Expecting this to break out in the short term, and this would be a big range breakout, which would ideally take it much higher, but a short-term target would be placed at 680, stop loss at 605. Second is a buy on Hero MotoCorp, a classical breakout followed by a small pause, and did not correct much in the pause as well, and now heading up again. So this indicates the momentum is strong and we get into the next leg. So a short-term target price of 4,100 and stop loss at 3,800.
Right. Kunal, what about your stock ideas?
So I'll go with two buys. The first one is one L&T Finance. That's a stock which I believe is heading towards a breakout above 154 mark, where it closed yesterday. So would suggest a buy with a target of 162, stop loss at 152. And SPI is on the verge of a triangular pattern breakout above 620 levels with a target of 660, stop loss at 600.
Okay, let's talk some of the individual stocks and newsmakers as well. Anisha is here in the studio. Anisha, a block coming in on Fusion Microfinance?
Oh, well, yes, one more candidate from the portfolio of Warburg Pincus, which is going to see a bit of a monetization. We've already seen the likes of CAMS, IDFC First Bank see some block deals because Warburg wanted to take some money off the table, and it seems like it is the case in Fusion Micro as well. So a couple of entities, namely Honey Rose, which is an affiliate of Warburg Pincus, and Creation Investment is likely to sell 9.25% stake in Fusion Micro today. The floor price has been decided at 535, which implies that it's almost 5% lower than yesterday's closing. So there might be a bit of a discount that happened, given it's a large deal which is happening. The overall size is 500 crores, but for the company's market cap, it's almost 10% stake. So that's why I said it's a large deal for them. In fact, there's a 60-day lock-in period as well for the seller, because remember, Warburg Pincus through its affiliates holds around 39.22% stake, and it seems like they are wanting to liquidate the entire position, though there is a 60-day lock-in period. But Nikunj, that's the case with a lot of these companies wherein private equity players are there. This overhang of supply remains, and for this one as well, they're right now floating 9%, but then there's 30% left as well.
Look at 5-star. I mean, every 3-4 quarters, there is one new P guy who comes and, sells the stock down. Similarly, that I think is the issue, I think, in terms of the supply-demand dynamics, at least for, Fusion Micro. Now, the stock's done very well for itself. And when typically a stock which got bombed out in 2022, was an underperformer in the initial part of 2023. It has really gained in the last couple of months. That clearly is a telltale sign that right now global investors feel that the fair value of the stock in a sense has reached. When long-term investors suddenly start selling and then they start selling back to back, either they have a compulsion that they've got some funds which are unwinding, or they feel that in the near term the stock actually has reached fair value. So while Fusion Micro, Anisha, 6 months ago I would have said that it was cheap, I think that's no longer the story right now. And also the category they represent, it's a category where you've had both hot and cold starts. So while I will not read too much into one broker coming in, but the fact that there is more which could actually come looking at the shareholding of Fusion Micro, that in a sense may just keep the stock subdued. I mean, a classic example here has been Zomato. Ever since SoftBank has also started selling the stock, it's really stuck between 115 to 120, because at that level, supply now seems to be constant. So if you're an institutional investor, you would say, look, there is a supply and the supply is coming at a lower level than the market price, so might as well wait it out more.
Yeah, absolutely. Okay. And two-wheelers, Anisha, what's the news there?
Ola DRHP, that's got everybody excited, because they are looking at filing the DRHP and the finalization of the papers as soon as this to next week itself. So that's likely to happen. They're looking at an overall, fundraising of almost 5,800 crores via this IPO, and that pegs the valuation at somewhere between 55 to 65,000 crores in a very broad sense. That's the kind of valuation they're looking at on the table. And even in terms of the various breakup of the sector, in terms of which company holds how much market share, that will come up for you on the screen. Ola Electric, of course, is on the top with 33% market share, but TVS and Bajaj are also there with 10 to 25% kind of a market share in electric two-wheelers, followed by the others like Ather Energy and Hero MotoCorp, etc. as well. What it is doing is it's giving a fresh, fillip to the entire space, because it's expected that the entire two-wheeler will now get re-rated. There are a slew of launches lined up by the other companies as well, and perhaps now some of them can also look at probably value unlocking and monetization of these partnerships. So that could be added, Philip, but overall a fresh trigger for the sector, Nikunj.
So Nisha, let's look at the setting in the auto space. You got TVS, which genuinely has really taken a giant leap forward in the EV space. You got Bajaj Auto, where the EV business has started, and it could be at least 3-4 years before it will have a meaningful impact personally on the balance sheet of Bajaj. And Hero MotoCorp, I guess, is just not there. Now, I mean, if the entire two-wheeler sector was going through the stress, you would have not seen this kind of a divergence in terms of valuation. So what are markets telling you? Go for EV. What are markets telling you? Companies which in a sense have got a future EV ready portfolio, that's the future you really want to bet on. And interestingly, Anisha, this all is happening when the FLAME 2 subsidy has been taken out. So now auto companies in a sense have to really fend themselves independently. What had happened because of the FLAME 2 subsidy, there were a lot of small players which had suddenly come into the two-wheeler space. Now experimental small companies in a sense are feeling the heat. So the way the EV space is moving, that you've got TVS from the listed space which has got market leader. Ola has been the disruptor there, and if Ola goes public, we've always seen that the rub-off effect which already it could have. So if you remember on Monday, I think we discussed Ola is going public. And today if you look at the TVS stock price in last 5 days itself, the stock has already seen a rub-off effect of that. Unfortunately, Hero MotoCorp has really gone behind the race. So Ola filing for DRHP, this one's going to gain. Ola filing for DRHP, maybe three-wheeler companies like Atul Auto or companies which have a EV presence. So it's all about EV. 2023 was all about Tata Motors. 2022 was all about Mahindra and Mahindra EV. And now I think it's going to be Ola and the rub-off effect it will have on the entire EV space per se.
Okay, that's the take coming in on all the stocks that are going to be in focus this morning. Anisha, thanks for flagging them off. We'll take a very quick break, but brace yourselves. The Nifty is indicating a solid 200-point gap up start. So we'll talk about all the stocks that are going to be in focus this morning and how is it that you can trade this market.
Welcome back. Let's focus in on stocks that are in the spotlight, and SpiceJet in the spotlight as it's approved a fundraise worth about 2,200 odd crore rupees. This is via equity share and equity warrants. We actually had an exclusive interaction with the company's chairman managing director Ajay Singh. Let's listen into what he had to say.
With this round of funding, we expect to come out of these problems and set ourselves on a growth path again.
Currently, what is the fleet size? And in terms of revival of the aircraft, in terms of the fleet or the aircraft that you are looking to get in from Boeing, can you share some more details on that?
We are flying 40 aircraft at the moment.
Okay.
We expect to enhance that significantly. We are working on the plan, so I can't tell.
Okay.
I can't say exactly how many, but we will certainly try and double our fleet over the next 12 to 18 months. Now. Some of these are aircraft which are grounded, which we will be putting back into service. Some of these are aircraft that we will be taking on lease, and some of these are deliveries that we expect to get from OEMs. So we are quite confident that over the next 12 to 18 months we will at least double where we are today.
Tough time that you have been going through, especially during the COVID period. But that was a time, and post the COVID period, you lost a significant market. You lost some routes, also the kind of problem that you're facing. So in terms of market share, how you plan to regain it? How you plan to
market share is a function of the number of aircraft that you're flying. As soon as we enhance the market, as soon as we enhance the fleet, you will see an increase in market share. So one needn't be overly concerned about market share. It comes back.
Okay, let's stay with the aviation space. And Interglobe Aviation conducted its management meet just yesterday. Let me take it across to Somit and find out what the key takeaways were like. Somit?
Well, Indigo's top management met with Motilal Oswal, and the key takeaways coming in here is the fact that firstly, though air traffic was subdued in the month of October and November, the management is pretty confident that domestic demand has not yet peaked and they have seen signs of revival when it comes to the month of December. Along with this, they're also saying that India is one of the fastest growing aviation market, and the total aircraft requirement by 2027 will be close to 1100 aircraft. Along with this, another key takeaway coming in is the fact that yields are expected to be flat on a YY basis in the third quarter of FY24. Now, usually a flat yield could mean negative, but in this case it's positive because the earlier signs that the management had indicated post the Q2 call was that yields have declined in high single digits. So from a decline of high single digit, if now they are faring at a flat level for the third quarter of FY24 is actually positive for Indigo coming in, and this could result into a good strong set of numbers in the third quarter of FY24. Along with this, the management also said that the international air traffic has also slowed, but yields expected to remain flat even on that front. And when it comes to international expansion, they are looking at more code share agreements. Currently, they have around 8 code share agreements with different airlines. On the engine issues, the company is expecting around 35 aircraft to be grounded from January 2024, and they are currently working with Pratt & Whitney towards compensation because of these groundings, and they have so far acquired around 12 aircraft from the secondary market through leases. Now, these lease costs are on the higher side, but they are not expecting any big impact when it comes to their cost structure going forward.
All right, thanks very much. Those are some of the latest updates coming in from the management meet at Indigo. Meantime, in the ever-evolving landscape of artificial intelligence, companies worldwide are recognizing the critical interplay between reputation, ethics, and responsible AI practices. Amidst this, a call for balanced regulations echoes, offering essential guidelines. My colleague Sumita Karir had an exclusive conversation with Sanjeev Bikhchandani, the founder of InfoEdge. Let's listen in to what he had to say about AI.
We should play to our strengths. See, we are kind of short of the capital and the compute power required to develop LLMs from scratch. But I would not, see, all the publicity may have been hogged by OpenAI and by Google, but the truth is there are more than a dozen other LLMs out there, right? We can exploit any one of them. We can partner with any one of them. What we at InfoEdge are doing is that we are not going with any public, LLMs. We are going with vertical LLMs where we don't have to share data outside. So because we realize our data is precious, and we therefore want to ensure that others don't have rights on it.
Now I want to ask you about the startup ecosystem. This has been a very tough year. We're almost, fag end of 2023. What does 2024 really look like to you? Is it going to be similar to what 2023 has seen? Barely 2 unicorns, a funding crunch, 75% funding is down in startups. And so starting specifically about InfoEdge, now Naukri's vertical growth has slowed due to slowdown in IT hiring. I mean, you've seen multiple cycles. How long do you expect it to last? Is it structural or transient?
The truth is we will find out as we go along. Okay. Right? So we can't really predict. But in the past, growth has always come back. Right? IT is too important and too central to the global economy for it to be in the doldrums for very long. Absolutely. So we are hoping next, maybe in 2-3 quarters, but we can't say for sure.
And so will
All right, that's the view coming in from Sanjeev Bikhchandani. Let's move right on and connect then with Sanjeev Bhasin, who's joining us on the show. Sanjeev, good to have you. Let's start off then by getting a sense from you as to what the outlook is on the entire two-wheeler space. We discussed this pretty extensively earlier this morning with the Ola Electric IPO now on the cards, talking about pretty smart valuations. What does this spell out for some of the existing two-wheeler majors in terms of market share, in terms of valuation, in terms of course, competition heating up within the space?
Yeah, good morning, Avanne. So look forward to a superb Thursday. Bears have been caught on the wrong foot, and the Fed now is doing what we had been saying for the last few months, that the Fed's credibility is at stake, and now rate cuts are the part of the course. Yes, two-wheelers are in a sweet spot, and particularly Ather. Ather is owned 100% by Hero, and I think they are the ones which are going to be biggest beneficiary of the valuation which Ola gets on the EV side. Secondly, remember that two-wheelers are anyway on a new high. So I think there is more steam there. I would also like to put on course that I think the four-wheeler space, particularly the new launch of Maruti's EV, is going to set the cat amongst the pigeon. So, take a basket of stocks, but we continue to think Hero Moto and Bajaj Auto on the two-wheeler side and Maruti and Mahindra on the four-wheeler side. Along with Ashok Leyland on the CV side, are best place to buy as a basket of stocks.
I'm just going to take a minute to establish that Fed rate pause. What does that mean for India and what does that mean for the world? By way matter karta na. What it matters is that what it matters for us. Now let's look at it. Interest rates in US have gone up from 2021 to 2023. 2 years we've been in an interest rate hike cycle. When interest rates they reach 4.5 and when they reached 5, the general consensus view by global allocators was, why do we invest in emerging markets like India, where we are getting 5% or short bond yield, risk-free return 5% or a volatile projected return of 10-11%. Well, the option is you go for 5%, and that's the reason why FIs actually have not been big investors in emerging markets in 2022 and 2023. So when interest rates they peak out, the reverse will start. So suddenly everyone will say, okay, interest rates have peaked out, now we need to hunt for yield. And if US Fed is talking about growth contracting, that means the real economy is going to contract much faster. That's one narrative which changes. When the rate of borrowing, which is interest rates, because if Fed has moved, RBI will also move. If it comes down, then growth stocks, they tend to outperform. What are growth stocks? High growth companies. For example, Zomato is a high growth company. Paytm is a high growth company. Growth stocks, they tend to outperform. So I will not be surprised that if suddenly growth stocks, they start outperforming. Third, the leverage will start coming down. Because if interest rates, they come down, Reserve Bank of India has a pause. If they cut rates, repo rates, refinancing, everything starts coming down, bond inclusion into India, all that factor will be at play. So companies which have a operating leverage benefit when they have a high debt, they also would benefit. So these are the factors which I think would be at play in terms of the new narrative of the world. When interest rates, they move higher, and when economies, they harden, typically that's the time defensives, they outperform. And I think now defensives could take a back seat. Basin Saab, I almost spoke like a theory professor right now, but would you agree?
100%.
क्या बात है, क्या बात है, जोरदार, जोरदार 100%.
होना चाहिए, तभी REC PFC डबल ट्रिपल है, तभी बैंक ऑफ बड़ौदा और GMR न्यू हाई पे है, because you are holding them. So believe in India, believe in the story, and look at the inward looking market, which is what you said. Now, of course, this will be a driver for technology, for listings, for the whole gamut. But the underlying remains, Nikunj, you have to be owning stock. There can be a 3-month lag on some large caps outperforming or underperforming. The broader market is refusing to give up. So enjoy the party, and it's still in young days, because you have to choose your stocks correctly. So I am extremely positive, and I will still use this correction or this upside to get into new stocks which we think can outperform. I just gave you yesterday the brief on Maruti. Naukri, sum of parts, has invested 2,500 crore in 83 listed companies. Just 2 have got listed, Zomato and PB Fintech, which are worth 25,000 on a market cap of 60,000 in Info Edge. 25,000 is in 2 companies, 81 are not listed. So if you are looking for the next play on the millennials or the unicorns, then Naukri becomes a very good play over there, and so on and so forth. So we can keep on. Maruti's new launch of EVs going to set the cat among the pigeon in 4-wheelers. They are raring to go. If you see, the labor disruption is over. They've got a clarity on that. So I'm looking at 12,000 on Maruti and 7,000 on the Naukri in this calendar year 2024.
Naukri, isn't the main business slowing down? Because ultimately Naukri derives large part of cash flow by jobs, and IT is where the slowdown has already happened, which is their mainstay.
Yes, but you have to take sum of parts. Sanjeev Bikhchandani is the first unicorn, and he invested very, very, wisely. And in retrospect, we will realize what wealth creator it has been. But we are looking at both sides of the picture. The slowdown may have been coming to an end now, and if there is going to be lower yields and lower inflation, then the US technology stocks will again start to rally. By the way, just 7 US Nasdaq stocks have run up 78%. The rest of the basket is asking to be caught. And in India, I think the hiring is again in a much, much better space than it was 6 months back. So some of part, this is just an opinion. Please do your own diligence. We own both Naukri and Maruti.
Okay, fair enough. That's your take when it comes to Naukri. But Sanjeev, it's difficult to ignore the fact that PSUs have had that dream run across the board. So what does one do with these stocks right now? Is the best already priced in? Is there still opportunity?
Well, that is the whole beauty of a bull market. It only keeps getting better, Avanne. And if you try to book out of any of them, you've lost out on the opportunity of go. I mean, now IREDA is up 3 times from its listing price. So a lot of froth may be there, but participation is still hanky. And if I tell you, mutual funds have actually lagged the market, particularly the mid-cap performance of PSUs, because they said we will not touch PSUs with a barge pole. And look what power, infrastructure, and railways and defense stocks have done. So still bullish on a select few, but taking some chips off is not a bad deal, which is why we suggested Tata Power as a run-up to the power stock. I still think there is a lot of value in some other names. And I like, this Z in particular. I mean, Z has hit a new high. You can take it down from me. The day you see the back of Goenkas, this stock will maybe double in the next 2 years. You cannot have an OTT platform and a media company like Z trade at valuations which are very, very, below subpar. Same is the case with some of these IT names. Now, LTIM, Kotak, Devyani International, a basket of these stocks can do extremely well. But please stay invested. Don't get caught up with new highs because they are here to stay.
Why do you like Devyani International? I mean, it's one space where I was reading a report, it says that there is a bit of a slowdown which has happened in QSR.
So simple, Nikunj, they are expanding their branches a lot, and that is eating to the margin because the cost structure is such. But you cannot but believe, I travel every week. Costa Coffee is eating into the market share of Starbucks. Kentucky is now catering to the vegetarian brand, and Pizza Hut is raring to go. It is even eating into the market share of Domino's, so both will survive. But their investments now will give returns over the next few months. And you are looking at one of the best QSR brands. So I am extremely opportunistic on this stock, and this actually can double from here in the next 2 years. Because the millennial spending, the type of patterns you're seeing on travel, tourism, you go to any outlet, you will see how it is. And I travel, length and breadth of the country, and airports, notwithstanding, the other branches are doing. So this one-time cost will continue for a quarter or so. But look at the brand. The brand is something which is going to go to immense strength over the next 2 years.
Let's get in some chart checks going. And although we've discussed these extensively on the fundamentals, Kunal, what are the charts of PFC and REC looking like?
Yeah, I mean, they're already on third, fourth, fifth gear in terms of the price movement. It's very difficult to try categorize that whether these stocks would get into an overbought territory or not, because 2 months back when PFC, REC, they were almost at 245 to 50 odd mark. The RSIs on the monthly charts was almost 90-91. Now the RSIs are almost 94-95, and these stocks are 400, 430 plus for themselves. So the momentum has been quite strong for these names. And I think till the time the momentum has been backed by strong volumes, I believe that this trend would continue. So, either you wait out for a breakout or participate with a smaller quantity and then keep on buying in case if there is any kind of a dip.
REC, PFC. Basin Saab, I'm going to discuss something which in a sense I'm yet to find an answer, and I think everybody is looking for an answer. Look, there is momentum in the market, right? If you sell now, markets, you may actually regret, because there is the best of the market is yet to come. So how do you choose when you know that there is momentum, yet you want to stay committed? This is not a market where you are getting stocks cheap. So the margin of safety exactly is not the highest. But if you sell right now, you are pretty much missing out on the best part of the rally.
So that is a proverbial wisdom question, Nikunj, and it will always be there. Anybody who has taken money off, and rightly so, will be, have the left out feeling and feeling of missed out. I still think the private banks are now looking extremely attractive. The LIC, Kotak, HDFC of the world, Reliance has done nothing. Now, if you are in some of the blue chips, your participation is there, but you will not rise like 20-30% over the next month. But you are still present there. And let me also say, you are aware, the biggest dumb money is the ETF flows, which sells at 15-17,000 and comes back at 21,000. They will change large caps. So I still think there is value in large cap banks. I still think there is value in select cement plays. And like I told you, media, autos, Maruti, Z, these are giving you very good entry points. Look at the prospect of the business going forward. But I take it with a pinch of salt, Nikunj. There is no harm leaving the last 10% for someone else to gain and taking money off the table. If you are and planning a Christmas holiday, then take it in advance.
And if you are not planning a Christmas holiday, then what would be a Christmas gift?
So Maruti and Z are two names I can bet on, and I can tell you Maruti is going to new highs by the end of the year, and so is Z at new highs. The day you get this resolution by Supreme Court, this stock is going to 350 and maybe 400 over the next 6 months.
Well, thank you very much, Basin Saab. Always a pleasure. अरे ये क्या हो गया? Naresh, just cut to the frame. Naresh, you okay? You smiling?
Yeah.
You're smiling for a change today?
I think you'll start making me smiling a lot more now.
It's a good no, yaar. Life is all about smiles and laughter, especially now that festival season is around the corner. It's been a good year. So I guess no one is complaining in this market. No one is Pankaj Pandey, it's been a good year for you also?
Yeah, hi, good morning, Nikunj. Thanks for having me. Yes, so we were one of the few brokerage houses where we had given a Nifty target of 21,500. I think we're closer to that. Our sense is that markets are trading at about 20 times on FY25 basis. Once we sort of incorporate FY26 numbers, our sense is that in a base case scenario, market should deliver in line with the earning growth in the range of say 15-16 odd percent. Could be higher also because what we have seen is that as of now, this market has made a high despite the fact that we have yet to see sort of significant FI inflows. And with the Fed kind of changing their outlook, I think our sense is that too much money is going to chase few good stocks, so which is why I think one should stay invested in the market. Probably better days are going to sort of come even more. So nothing looks cheap at this point in time, but I think wherever we see pockets where the stocks have not really done well from a price performance perspective, and the overall tailwind continues to remain strong, that is what we have been sort of looking at in terms of recommending.
Okay, fair enough. Meantime, PI Industries was clearly in the spotlight yesterday. Of course, that hammering took place on Tuesday's trading session yesterday. As well, we saw the stock react, but it's been nothing short of a roller coaster ride. We did have the management who continued to say that this is not material news. They continue to follow into different segments. They reiterate their growth guidance of 18 to 20%. Pankaj, just curious if you tracked this one, how you've read into the reaction and all that played out on PI Industries.
So I think, Avanne, if you look at some of the sectors, like say, for example, steel or chemicals, they're still sort of getting impacted because one is not sure what is the growth trajectory for China. And at times you sort of keep getting news in terms of dumping of certain chemicals or even steel from China. So unless and until some measures are taken, I would not sense that, or it gives it is very difficult to build a confidence that China is going to sort of witness a stable or lower growth. And it may not really cause the kind of volatility or the anxiety. So from that perspective, I think global-oriented sectors one should still stay away from. I think domestic-oriented sectors are looking a lot more better. So I think the tailwind there is looking a lot more stronger. And that includes even IT also.
Move right on then and focus in on JSPL. They had a management meet. Let's find out some of the key takeaways and more importantly, what the expectations are from Q3 because the management sounds rather optimistic, isn't it, Ayesha?
Well, yes. So Phillip Capital met with the management of JSPL and on the back of that, they've come out with this note. First up, they've spoken about third quarter, where they say that the third quarter is expected to be strong. Volumes are expected to be on the weaker side, but margins could expand on a sequential basis due to higher steel prices, and perhaps EBITDA per ton could also see a sequential improvement in the third quarter. As far as capex plans are concerned, they say major steel volume growth is not expected to come in the near term. We will see steel volume growth only FY26 onwards. As far as medium term specs expansion is concerned, they say EBITDA per ton could expand in the medium term. They've undertaken several cost rationalization measures such as coal and iron ore mine, which will start contributing in a staggered manner from the fourth quarter of FY24, and hence they are expecting EBITDA per ton expansion in the medium term. Phillip Capital, meanwhile, says that given their heavy capex, they expect debt to peak out in FY25 or in the first half of FY26, but will remain under 1.5 times of EBITDA. They also say that quicker commissioning of coal mine has the ability to increase EBITDA of the company by as much as 10 to 15% by FY25 and 26. So yes, in the near term, third quarter is expected to be strong both on EBITDA margin spreads front, but in the medium term, EBITDA is expected to expand on account of volume growth and cost rationalization measures that the company has undertaken.
Pankaj, what is the logic behind metals coming back? I mean, if world is slowing down and if China has not picked up, US is slowing down, then it should be the other way around, right?
So, Nikunj, I think one factor which will sort of play for metals is that when you look at this sector is going to do the maximum capex of about 11 lakh crores to take the capacity to 300 million tons in the next 5-6 years. In fact, from this next year onwards, you'll see the capex for top 5 players doubling from whatever has been existing in the last 3-4 years. If a sector is doing so much of a capex, obviously there is an expectation that government will come up with some measures to sort of protect the industry, because you can't have a situation where the sector is sort of spending so much on capex and is left unprotected. So our sense is that these measures will come. Probably something is there in the news also, but I think as and when these measures come, these segments or this metal as an entire play, I think should do well, because we haven't seen much of a price performance. Domestic volume growth has been good. It is largely the challenge on the realization front, which has been sort of muted. So our sense is that some measures will come, but timing is very difficult to sort of predict for that. But one can stay positive on metals on the hope that government is going to take some measures. Timing, like I said, is difficult to predict.
Okay, fair enough. Meantime, Pankaj, let's also get in your take as to what the outlook is within the entire hospitality space, with, of course, talking about the New Year and the December rush. We have seen a lot of fervor within airlines, hospitality as a whole. How does one play this from a stock market angle?
So largely, when you sort of look at airline as a space, we are slightly skeptical to sort of play the hospitality theme through them. Largely because of the volatility, what you see because for airlines sort of do well, the entire value chain, right from availability of engines to so a number of things have to be right. But I think when you sort of look at the hotels as a segment, I think that is one segment which looks quite good. So be it Lemon Tree, be it Indian hotels, or even a player like Ayesha, which is looking to sort of ride only the premiumization wave. I think these segments look quite good from the perspective that overall, while the occupancies are still expected to be higher, but I think the delta is still going to come from the overall ARRs, which are going to sort of keep inching up. So combination of these two is going to sort of deliver decent growth for most of the players. And good part also is that the future expansion is not really tied up only on the capex side, so they're looking at asset-light strategies as well.
Right, real estate as well as a pack is going to be in focus. US Fed now hinting that it's going to be 3 rate cuts come next year. So, raising really hopes of what the RBI is going to do, while of course it was a status quo this time. But let's see what the future trajectory is going to be. And maybe some of these rate sensitives do perk up in trade. Who knows? Already they've had a fabulous run this year. Kunal, any fresh realty names that one can look at?
Well, I mean, in terms
or
of...
other realty names for fresh trades?
Yeah, so I think I would still believe DLF, Anantraj are two stocks which still look very attractive even from current levels. And I think the typical way to try and look out for is that real estate as a pack is very high beta in nature, and we've seen that over the last decade and more. That whenever these stocks they get into their own set of a bull market or a bull trend for themselves or a big breakout, those breakouts they don't last for a few months or a couple of quarters, but they engulf themselves into multi-years of up move. So I would believe that many of the real estate stocks look fairly attractive. They are poised quite well. I would still go with the likes of DLF and Anantraj. You may probably have something like Godrej Properties or Oberoi Realties which could be added into the space. But I think largely it's always best to try and have at least 3 or 4 names from the pack of realty to be a part of one's portfolio.
And Nikunj, I think that was your takeaway as well, right? From your interaction with Lodha, Abhishek Lodha, that is, that this is just the start of it all. As the economy begins to open up, as purchasing power increases, real estate is going to boom only further.
Ayesha, what is the big picture argument? Number of Indians who don't own home, and buying a dream house, I think everybody wants it. So if you just look at mathematically that where the number of, where the economy is headed, where the number of young couples who in a sense would be joining the workforce. So mathematically, I guess the whole appeal for the real estate sector is going to be extremely strong. Then it comes to affordability. Now the real estate sector has been in a 7 to 8 year downturn, and in that 7 to 8 year, the per capita has gone higher. So affordability, I guess, is not that bad. And see, the sector has seen a massive consolidation. I mean, post RERA, Look at the number of builders over there in NCR. Look at the number of developers who are left now. Similarly in Delhi and Bombay. Similarly all states. So that affordability, desire to buy, affordable interest rates, good corporate governance, all them adds up to the fact that this is a cycle which is not going to go in a hurry. I can argue back and say that it's a good idea to buy real estate or real estate stocks. That's the argument we should always do. But in terms of a big picture argument, it's intact. Where the problem is HFCs. I mean, HFC was supposed to be this talked about theme and everyone thought HFCs will continue to grow. But the rural slowdown is really having impact on that.
Yeah, and that's real as well. But you know, since we're on the subject of real estate, let's just hear out Nikunj's interaction with Abhishek Lodha.
We are of the we can, keeping our balance sheet very, very conservative, we can grow at 20, our pre-sales and top line at 20% and deliver 20% ROE. I think if our internal cash flow generations are that strong that we can sustain our 20% growth, then there is no reason for us to add on risk.
Now you guided for pre-sales and 2 quarters, you've achieved 48% of that. The second half, this time we've had Diwali Dussehra, and the second half traditionally is a better half. So can I safely assume that if I put data point, you are on course not only to meet your guidance but to beat your guidance?
I would say is that the 20% growth that we promised last year, we of course promised it being taking into account what we felt the year was going to be like, and it looks like the year is on track to meet that guidance.
Is there a volume growth advantage which you have in that 20%?
Yes, of course. Like I said, we like to keep price growth modest, not low and not very high. We like to keep price growth a little below wage growth. So this year wage growth in the country is going to be around 9%. We are targeting price growth of between 6 to 8%. And therefore the rest of it is all going to be volume. So we are growing our volumes by about 13-14% this year, partly from existing locations and partly from new locations.
Now I'm going to ask a question perhaps on behalf of our viewers and your shareholders. Everyone has a different time frame when they're investing in a company. So in 3 years, what they should expect from you, in 5 years, what they should expect from you, and beyond that, I think we'll discuss the next time.
No, I think short term, medium term, which is the 3 and 5 year sort of timeline that you mentioned. I think what you can expect from us is predictable, low risk, 20% growth in our top line and 20% ROE.
That you can do on this large base also.
Yes.
And keeping the debt to equity under 1.
Means our ceiling that we've set for ourselves is 0.5 times.
All right, that's a tidbit of the conversation with the management of Lodha. Let's get a move on then and talk about these housing finance companies, Pankaj, that Nikunj was alluding to. What was touted to be a very promising space hasn't quite played out or delivered as promised. Your views?
Right, Avanne. So we were sort of bullish on a company like, say, Canfin Homes, while there were earlier issues in terms of certain challenges what they faced in some branches. But we haven't seen the kind of price performance because when you sort of look at from a historical perspective, their NPAs have been lower than 1% across cycles. So we are also sort of not very sure why the stock is not doing so well. But when you sort of look at the entire value chain of real estate, I think what we have started liking is also the ancillary companies. So for example, the likes of plywood or even the tile players like Kajaria. So we like Century Ply and Kajaria because our sense is that when these houses start to sort of get into delivery mode, the demand for these ancillary products is going to sort of go up. And we haven't seen meaningful price performance in some of these categories. So volume growth along with margin recovery, I think should do well. And real estate is a cycle which typically our senses should last for 5-7 years. And probably we are in the first year or 2 years in the cycle. So you still have a long runway for growth. Obviously, the stock prices are not going to sort of perform in a single straight line. So you'll have bouts of correction. But we like this entire space. I think probably the economy segment is still not sort of pitching up the way it should. So only the premium segment is sort of doing well. Probably then we'll see Canfin Homes or some of the other HFCs sort of do well. But interest rate declining scenario ideally should help these companies to sort of do some catch up.
Suresh, comment on Infosys breakdown yesterday, and that in a sense was a trend for IT. Did IT add short positions yesterday, Naresh?
So yesterday was an odd move. Did not expect much of a correction, but I don't look at a lot of derivative data. But the momentum has not been great across the IT names, at least on the large cap side. It is very clear that TCS, Infosys do not see much of a follow-up move, unlike what happens in the rest of the mid-cap space. So overall, in the IT pack, you have clear leaders like HCL Tech, which hits an all-time high. And you have something like Infosys, which continues to struggle, or Wipro, which just does not make a bounce back. So there are other names which have clearly shown outperformance. The new ones which could be on that league of outperformance could be LTI, Mindtree, and LTTS, which have consolidated well enough. The other names have continued in momentum like Coforge, KPIT, etc.
Okay, some of the buzzing stocks there, and let's just talk about, in fact, some more that held out from yesterday, and I think that's going to be the case today too. Just looking at the movement in the Singapore GRMs, perhaps the case for OMCs to move up from here only gets stronger with the kind of decline that you've already seen in the Brent prices. Already OMCs have been quite the trade of late. Yesterday too, you had a big move come in for HPCL. Stock held out by about 5%, and that's pretty much the case all across. PPCL, IOC as well holding out well. Naresh, a decent move in HPCL. Do you think there will be a continuation of follow-through on both HPBP and IOC?
Yes, so expect this to be a new trend which has started for the whole sector as such. So we got a little bit of a dip which was normal and required. So the stock corrected from close to a top of 396 odd levels to around 356, a normal 10% correction, and we made a bounce back. So expecting this again, it should cross about 400 and slowly head up towards 450 levels. So the whole sector, IOC, BPCL, HPCL look promising. There have been large volumes in this rally in November, December. So it's not just a price move, but it has been a strong volume also out here. So expecting a further move and a structural breakout to continue. So buy at current levels with an option to actually keep adding on dips.
Meantime, Pankaj, I wanted to also get in a take from you as to what the outlook is on some of the metal stocks. Most of the brokerages are indicating that it could be a little bit cautious when it comes to the entire metals basket. What does the year ahead hold for the likes of JSPL, Tata Steel, SAIL, etc.?
So, like I highlighted, so while we would expect a decent volume growth, I think the challenge always has been the realization and where China sort of sets the pricing, depending on the quantum of dumping what they do across segments, and which is why metal as a pack hasn't really done so well. But our sense is that government is going to take some measures. I'm still not sure the timing about it. But we are quite positive on metals from the perspective that some measures will be taken. So it's more of a wait and watch kind of a scenario in metals. But given the fact that we haven't seen much of a price performance, the risk reward is extremely attractive in metal. So I think this is one of the few sectors which hasn't really done much in terms of pricing. And I think on an overall 5-6 year basis, the volume growth is going to be good, given the fact that infrastructure spend is going to be pretty robust. So we like this space. Timing is what we are still not very sure of. But if somebody can wait for some period of time, I think probably this is one of the better sectors to be into from a risk reward perspective.
All right, that's the view coming in on the entire metals basket. Meantime, just take a look at fresh brokerage notes this morning, and CLSA has come out with their report on the oil and gas space, saying that as of now, they don't see any major impact on the petrol demand versus a no EV scenario. So we'll discuss that sector. But 9 a.m., so let's find out what the pre-open rates are indicating. Yes, a print of 70K on the Sensex. That's 440 points higher. For the Nifty, holding out by a solid 108 points at 21,000 odd. Let's get in those mid-cap ideas going as well. And Kunal, what's looking attractive?
So one of the names which I've been highlighting over the last couple of days, and that's Clean Science. That's a stock which has been looking attractive. Yesterday, the stock crossed about the 1500 mark and on closing basis as well. So I'm expecting a strong follow-through up move for the stock going forward, revising the targets higher from 1550 given earlier to 1600. Traders could look at a fresh buy even at current levels. Stop loss for the trade, 1445.
All right, owing to the record highs on Wall Street, perhaps not
highly unexpected to see these levels on the market. So in light of this, Naresh, what's your top mid-cap call?
So that would be a buy on Lemon Tree. The stock is on verge of a breakout above this 120 mark. Good enough consolidation done, the last break, and it has gone in proper steps. So the earlier breakout at 70 went up to 100, did a retest of 70, then came back to 100, made a breakout of 100, went to 125, did a retest of 100, and now we are setting up for a move above 120.25. So ideally should go towards the 140, 160 mark in this move. A stop loss to be placed at 115.
Right. Okay, on that note, we're going to take a very quick break, come right back. We'll count down to the market open this Thursday morning.